Hello and welcome back to the Geordie Pig Investor channel. Today we're going to have a look at, is Starbucks Corp stock a buy right now? I did recently do a Starbucks analysis video, but since that video was made a few months ago, there has been some big changes to Starbucks, as you can see on the graph below. So what is Starbucks? Let's start off with that. Well, Starbucks Corporation engages in the production, marketing and retailing of specialty coffee. The company is headquartered in Seattle, Washington, and has over 34,000 company-operated and licensed stores. The company operates through three segments, which are North America, International and the Caribbean. Within these include United States, Canada, China, Japan, Europe, Middle East, Africa, you name it, Starbucks is probably there. Some key stats to do with Starbucks: it is based in America, it is part of the restaurant industry, has a market cap of over 103 billion. It went public in 1992, has over 380,000 employees, has a really nice dividend growth streak of 13 years and a 5-year dividend growth rate of 8.88%, and its current dividend yield is 2.93%. We can see on the graph that its 1-year performance has crashed as of late, so it is now down 26% over the last year. And what we're going to do today is have a look to see if it is a buy, sell or hold. Let's have a little look at Starbucks' earnings call and fundamental analysis. Their earnings call. So their performance so far in 2024 has been rather disappointing. Their Q2 total company revenue was 8.6 billion, which was down 1% year on year. Their global marketable store sales declined 4% year on year, driven by a 3% comp growth in North America. A major hit was in China, where it had a declining traffic and negative 11% comp growth, which is one of the main areas that they're struggling in right now. While these results don't look amazing on paper, you have to sometimes zoom out and look at the bigger picture though. With a company like Starbucks, it is one of the powerhouses in the industry. They have great capabilities with their free cash flow and the opportunities with many long-term projects that they currently have going on. Remember, Starbucks has led the industry for more than 50 years now because of its unique style they have built as a company and still remain a powerhouse as highlighted below. So the key fundamentals for Starbucks, let's break them down and see how they're actually doing. Well, they've got a positive free cash flow of over 4 billion right now. They have exceptional 3-year revenue growth at 15%. They have positive operating income at 5.6 billion, positive gross profit at 10.1 billion, positive net income at 4.2 billion. They have extremely low debt to equity at negative 1.85. They have high interest coverage at 10.17, an average Altman Z score at 2.97. They do have positive net debt at 12.5 billion and have not the best short and long-term solvency. Having said this, to look further into their free cash flow, as this being one of the main metrics that I like to look into, we can see that it has improved gradually since 2020. They did struggle in 2020 due to the pandemic, and it was especially rough because they had to shut down many stores while the pandemic was on. However, in this period, they also heavily invested in digital capabilities, so that meant that they had some short-term losses, but it was going to be for the better in the long term. Since then, they have seen their cash flow increase at a very nice healthy rate, and like I said earlier, they're now up over 4 billion. They also have a 60% free cash flow payout ratio, which means that they have plenty of room to grow the dividend and potential share buybacks. These numbers look very promising to me, and I personally don't have many alarm bells ringing from them, like many people currently do. Moving on to see Starbucks' discounted cash flow valuation. The DCF is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on selected operating models. So to remind you, Starbucks' current price is $77.85. And when plugging in the numbers of a discounted rate of 8.5% and a terminal growth rate of negative 3%, we can see that the worst case scenario comes out with Starbucks being worth $50.07. The base case, when we plug in a terminal growth rate of 0% and a discounted rate of 8%, comes out of being worth $83.44, which is an undervaluation of 7%. And the best case scenario with a discounted rate of 7.6% and a terminal growth rate of plus 3% is an undervaluation of a massive 53%, as it would be worth $167. By adding this with the relative valuation, we can come up with something called the intrinsic value. The relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. These metrics include EV to revenue, EV to EBITDA, and PE ratios. You can also use other metrics as well, but these are the main three that I personally like to use when coming up with my valuations. Starbucks, when plugging in the numbers, its worst case scenario is worth $111.90, which is an undervaluation of 30%. The base case was worth $125.35, which is an undervaluation of 38%. And the best case was worth $135.10, which is an undervaluation of 42%. Like I just mentioned, we can then work out the intrinsic value by adding the two together and dividing by 2. So the worst case scenario for the intrinsic value is actually $81. The average case being worth $104.40, and the best case being worth $151. I also like to have a look at another method so that I can back up my values here and I can get as an accurate representation as possible for the companies that I'm trying to value and potentially buy into. What I use is called the Wall Street estimates. The Wall Street estimates are an average estimate of a public company's quarterly earnings and revenue that leads to a valuation of that company. These numbers are forecasted by company-specific analysts who provide research on that particular company and therefore come up with what they believe is an accurate valuation of the company. There are going to be multiple analysts for companies the size of Starbucks, and they are looking on the daily at the company and analysing it to come up with these numbers. These are the 1-year price targets. Its worst case scenario, they have it being worth $75.75, which is a 3% downside. On an average case scenario, they believe it is worth $91.63, which is an 18% upside. And on the best case scenario, they actually believe it is worth $126, which would be a 62% upside. So overall, Starbucks' price is $77.85. And now that I have all three valuations, I can combine the worst, average and best case scenario for the three, and we can come up with our valuations. The worst case valuation being $79.24. If you wanted to use a 10% margin of safety on this price, you'd be looking at buying it around about $71.32. If you wanted to use a 20% margin of safety on the worst case price, you'd be looking to buy it $63.39. On my average case, it comes out of being worth exactly $100. So if you had a 10% margin of safety, you'd be looking to buy it $90. And if you had a 20% margin of safety, you'd be looking to buy it $80. And then the best case scenario came out of being worth $151. So with a 10% margin of safety, you'd be looking to buy it $135.90. And with a 20% margin of safety, you'd be looking to buy it $120.80. So what does this mean for Starbucks? Well, my conclusion is Starbucks a buy right now? Overall, I think the company is showing some promising signs, even if they are having some short-term issues with the likes of the decline in China. Yes, this may be worrying for some, and yes, you don't want to see negative numbers coming in, but I am way more bothered about the long term as I'm holding my stocks for 10 plus years, and I only see Starbucks having exceptional long-term dividend growth with real solid fundamentals in place. They have a really good 5-year dividend growth rate alongside a creeping dividend. It's getting close to that 3% mark now. And it also has such strong free cash flow. When you dive deeper into the company, you can also see that it has really strong operating income, gross profit, net profit with high interest coverage and super low debt to equity, as we highlighted earlier. The current price is further highlighting how exceptional the value is, as you can use a 20% margin of safety on my average case scenario, and it is still worth $80. With its price being only $77 right now, I believe it is massively undervalued, and I personally have been adding a lot to my position. It is now my biggest single stock in my portfolio, as I believe it is just trading at such a good price. And for me, I like to buy stocks when I believe they are at a good price. This is a very, very good opportunity, and I'm very, very happy to add in at this current price. I hope you've enjoyed today's video. This is my analysis on Starbucks. If you'd like to see an analysis on any other different types of stocks, please let me know in the comment section down below. This was a really fun one to do because, like you say, I'm already heavily invested in the company. You may think that when the stock took a massive dive a couple of weeks ago that I was worried about my current position in Starbucks, but it only made me want to add a lot more to the position, hence how it's now become my biggest holding in the portfolio. Let me know your thoughts on the stock. What stocks have you been investing in? I hope you enjoyed today's video. This is the Geordie Pig Investor, over and out.